So what is the January effect and what does it mean for the stock market and more importantly, your portfolio? Stick with me as we dive into the details. My name is Bryan Cannon and welcome to Markets in 5. Before I jump into the January effect, let's get a quick read on the market. The S&P 500, is now officially broken out to all new highs. So it eclipsed its previous high, which was set back in the end of very end of 2021. So now we've just finally broken out. So oftentimes when you break through a major resistance like that, it's not uncommon to come, test it and make sure it holds. And so we did get a little pullback there the last day of January, but we are in the upper end of this kind of this trading range, this upper channel trend. So we're watching that just to make sure. Now it doesn't mean that it's going to necessarily pull all the way down. It just it could consolidate those gains and continue to head up. It really just depends on earnings, depends on a lot of macro and geopolitical kind of things in the market right now. But essentially, although the market is at all-time highs, we do have this negative divergence that needs to be kind of worked through. So what I mean by that is that you've got lower highs set on the RSI and the MACD down here. However, you've got higher highs in the price of the market. So negative divergences don't always resolve themselves to the downside, but oftentimes they do. And so we just need to be aware of that and just know that, with the market overbought and momentum starting to fade, it's a pretty good recipe for a pull down. And so when you combine that with the fact that February is not a strong month, I'll talk about that in the next slide. It could be a recipe for possibly folks to start taking some profits and ultimately see the market pull down a little bit. So but again, as of right now, the RSI is above 50 and looks really strong. Again, we don't want that RSI to drop down to below 50. And then the same with the MACD. It's still positive. It's above zero. Now we do have again a negative divergence down here as well, lower highs. But it is still positive. Looks like it's crossing over a little bit. We've got some big tech earnings this week, some of which are turning out quite well, and some of which that are not. So it's kind of a bifurcated results at this point, but. All in all, everything from a chart perspective looks fine. Just watching that negative divergence. So the basic premise behind the January effect is basically as goes January, so goes the market. So if the market ends on a positive note, generally speaking, the S&P has a favorable odds of being positive and vice versa. So, it's important to kind of just have that in your back pocket and be aware of it. So, what did January do this year? So far, we did 1.59% in January. That means that, it wasn't the best January, but also wasn't the worst. And so when you have returns that are positive in the kind of the 2 to 3% range or around there, historically speaking, the market usually ends up between 8 and 10% on the year. This is going back to 1950. So, so we'll see what happens. I mean, we've got a lot of things at play this year. We've got, politics being an election year. We've got, persistent inflation. In fact, the Fed this week came out and announced that they would not be cutting rates. The market had anticipated a rate cut, and they said, no, not yet. So the market kind of got pounded the last day of January, or quite frankly, we would have had a much better January. So we'll see what happens. But if you look historically speaking at February, it's just not a historically strong month. You can see, in fact, it's one of the weaker months, along with maybe August and September. And so we want to just be aware of that. Now, if you look at it a little bit closer and peel the onion a little bit further, it's not the full month of January. Generally speaking, the weakness primarily is in the second half of January. So that's basically the 15th through the end of the month. And I think the reason for that is by that time we've kind of gotten through the majority of earnings season. So we've gotten most of the earnings reports behind us. The fundamentals aren't quite as at play anymore. And so now it's more, I think, media driven, headline driven. And so it really just depends on if the market or if the media decides to kind of slant us in a negative direction or a little bit more fearful direction. And so if they do, that could certainly be the instigator for a pull down in January. And then, but if you take a look at March and April, those are historically two of the stronger months of the year. So I would say, it's probably a good idea when we get to kind of the lows or a nice pullback, maybe late February on into maybe early March. It's probably a good time to hit the rebalance button, maybe reposition some things and take advantage of some weakness in strong companies that are growing. So that would be kind of the smart play at this point. So in wrapping up, you can see that if we just follow one clue, the January effect, we're going to end the year higher, right? Well, there's a lot of things at play. So again, technical analysis and trend following uses a collection of various clues and signals and strategies, and so this is one of many. But certainly is an interesting clue, and so we'll see how it plays out. But I think it's going to be very volatile this year, and I think it's going to pay to be a little bit nimble and light on your feet. But if you have any questions, give me a shout, and I look forward to seeing you on the next Markets in 5.